Welcome, everyone, to Markets Deep Dive. We're really glad you could join us today. So today we're going to unpack a really interesting situation. We're looking at the U.S. healthcare giant, UnitedHealth Group. That's ticker UNH. Now, before we get into the weeds, just a quick but really important reminder. Everything we talk about here, it's strictly for informational purposes. It's definitely not investment advice. Please don't take it that way. Our whole aim here is to give you information, maybe empower you a bit with knowledge so you can make your own decisions. And always, always remember, investing in financial markets carries significant risks.
Okay. And look, as we go through this, we really want to hear from you. If something sparks a question or you've got your own take on things, please drop it in the comments below. We'd love that interaction.
Absolutely. And with UNH, there's certainly a lot to talk about. What's particularly striking to me is just how divided the narrative is right now. It really feels like a tug of war over where this company is headed. That's a great way to put it, a tug of war. And that really gets us to the heart of the conflict, doesn't it? The whole investment case for UNH right now.
Yeah.
Because on one hand, you've got this operational beast, right? Vertically integrated, market leader, throwing off tons of cash, consistent growth. But then it's also sailing into this, well, unprecedented storm. Regulatory probes, political heat, operational headwinds. You mentioned it, nearly half its market value gone in the last year. It's quite something.
Yeah, it really crystallizes into these two opposing viewpoints. Is it a coiled spring or is it a value trap? The bulls, the coiled spring camp, they're basically saying the market has panic. They see this price as like a generational buying opportunity. They think all this financial power is just being held down by, temporary bad feelings. Once the regulatory stuff clears up, boom, the stock could just snap back hard.
Right. And on the other side, the value trap folks, they see this deep discount, think, warning sign, not bargain bin. No. They're arguing that this regulatory assault coming from multiple directions could actually permanently damage profitability.
Yeah.
Not just for UNH, but maybe the whole managed care sector, with UNH right in the center of the target. So for them, the low valuation isn't cheap. It reflects a business model that might be, well, fundamentally broken going forward.
Exactly. And to really understand that tension, you kind of need to grasp UNH's structure. It's got these two engines, right? It's not just an insurance company. You've got UnitedHealthcare, the traditional insurance arm covering about 51 million people worldwide. But then there's Optum. And Optum is huge. It's their health services division. You've got Optum Health providing care, Optum Rx, the big pharmacy benefit manager, the PBM, and Optum Insight doing data analytics.
Yeah, and on paper, that setup, that virtuous ecosystem, it sounds unbeatable, doesn't it? UnitedHealthcare's patients feed into the high-margin Optum businesses, and Optum services, like managing drug costs through the PBM, are supposed to help lower costs for UnitedHealthcare members.
Yeah.
But is it maybe too interconnected? Is that integration, that supposed strength, actually becoming a vulnerability now that regulators are really zeroing in on Optum?
That's the million-dollar question, isn't it? That dependency. Because the insurance side, UnitedHealthcare is facing pressure. Medical costs are rising, especially Medicare Advantage, squeezing their margins. So that naturally makes the whole company rely more heavily on Optum for profits and growth. But as you said, Optum is now directly in the regulatory crosshairs. The PBM business, Optum Rx, is under fire for its pricing practices. And the whole company's facing this DOJ antitrust probe looking specifically at the link between Optum and UnitedHealthcare. If Optum takes a major hit from regulators, that's a huge risk to the entire UNH growth narrative. A systemic risk, really.
And yet, despite all these headwinds, the underlying financials, they still look pretty solid, at least on the surface. Revenue was up, 15% in 2023 to over $371 billion. Still growing in Q1 2025, up another 10%. But here's the key insight, I think. That growth, it's getting less profitable. Their medical care ratio, the MCR, basically how much of the premium money goes out to pay claims that climbed to nearly 85% in Q1. 84.8%. That rising MCR really shows how these higher medical costs are squeezing the core insurance business. And that just makes them even more dependent on Optum, the very part that's under regulatory scrutiny.
Right. It's a bit of a feedback loop there. And it does raise questions about, the sustainability or at least the quality of that cash flow. I mean, even with profitability getting squeezed, UNH is still a cash machine. Operating cash flow jumped to $5.5 billion in Q1 2025 alone. And that cash allows them to keep doing things shareholders like, raising the dividend 15 years straight now and buying back stock pretty aggressively, which, if they get through this okay, those buybacks could be very good for remaining shareholders.
Okay, let's pivot a bit more directly to the regulatory stuff, because that seems to be the big uncertainty overhang, as they call it. The whole managed care sector is dealing with shifts, like moving towards value-based care. But they're also getting hit by higher medical use, particularly from seniors. And then the government reimbursement rates for Medicare Advantage, which is a really profitable area, those came in lower than expected. That puts pressure on everyone in the industry.
Yeah, and beyond those broader market dynamics, UNH is facing this, well, multi-front assault, legally and politically. You've got the DOJ antitrust investigation we mentioned, looking at Optum and UnitedHealthcare. Intense focus on the PBMs. Questions about how they calculate risk scores and Medicare Advantage that affects how much they get paid based on patient sickness. High rates of claim denials being scrutinized. It's not just one thing. It's the potential combined impact of all these investigations that could be really damaging, much more than any single fine or settlement.
So where does that leave the valuation? Because honestly, it looks kind of wild. Wall Street analysts, on average, seem to have a moderate buy consensus. The average price target is around $360, which implies, what, 27% upside from here?
Yeah.
But you can feel the nervousness. There's a huge range in those price targets.
That's it, exactly. You've really nailed the disconnect. The company's trading at a trailing TE of about, what, 11.8? That's way below the healthcare industry average, around 20.8. But the really jarring thing is the gap between its current market price, around $282, and what various discounted cash flow models say its intrinsic value should be. Those estimates range from, like, $420 all the way up to over $1,100 per share. And that huge range isn't just numbers on a page. It vividly shows how wildly different analysts' beliefs are about how bad these regulatory issues will be for UNH long term. Some clearly see it as temporary noise, others as a fundamental game changer. The market is basically demanding, a 33–40% discount just to hold UNH stock right now because of all this uncertainty.
Okay, so summing it up, a company with objectively strong fundamentals,
Right.
massive cash flow generation, trading at a significant discount to what many models say it's worth. But, and it's a big but, it's fighting this multi-front regulatory war. The risk rating is assessed as HIGH, not because it's going bankrupt tomorrow, but because the uncertainty about its future operating environment is just profound and really hard to put a number on. It's this high-impact, maybe medium probability risk that government actions could permanently change their business model.
It really forces you as an investor to pick a side almost.
Right.
Are you betting on the strong fundamentals winning out, or are you more worried about the political and regulatory risk? It brings up that classic investment question. How do you weigh the numbers, the quantitative discount you see, against these qualitative, potentially game-changing risks? Is a 35 or 40% discount really enough to compensate you for the chance that the whole business model gets impaired? That's the dilemma right there.
Wow, quite the deep dive indeed. So if you found this breakdown helpful or insightful, please do share it with anyone else you think might be interested. And definitely please leave your comments and questions below. We're genuinely curious to hear your perspectives on UNH. What do you make of this situation? And finally, don't forget to subscribe to the channel. That way you won't miss our future deep dives into what's moving the financial markets. Thanks again for tuning in.